Welcome to Pro News Weekly. With some hiccups and pauses, the markets are completing the main themes of the outgoing year. The leaders are building up the gap, while the laggards are facing a new wave of pressure. This is how the tax optimization effect manifests itself, with market participants locking in unprofitable positions to optimize tax payments at the end of the year. The dollar was among the strong performers in 2024. Strong economic data helped the Fed to shift expectations for monetary policy easing. A first 50-point rate cut in September was followed by two 25-point rate cuts. However, the central bank's tone has led markets to lay down a 90% probability that the Fed will not ease policy at its next meeting in late January. The tighter tone of monetary policy brought the dollar back into investor focus with the start of October, and by the end of the year, the dollar index was at two-year highs, breaking the reversal area of the second half of 2023 and the first half of 2024. In thin air territory, it is easier for the dollar to move in one direction. Moreover, the two-week retreat in late November allowed for renewed upside momentum. We should not be surprised to see the dollar creep further higher at the end of the year and the first sessions of 2025. The return of liquidity to markets in January could both accelerate the trend and reverse it. The dollar does not look locally overbought, having reached new highs, and could further realize its upside potential of 4 to 6%, targeting 112 to 115 from the current 108th. U.S. stock indices, which took a hit from the Fed's tough tone, were cheered up by soft inflation data from the Personal Consumption Price Index. The recovery of losses is slower than the decline, but the S&P 500 is less than 1% away from all-time highs and is on the cusp of entering the December consolidation area. The Dow Jones is much heavier, at 4% below the peak and still under the 50-day moving average. The dynamics of this index are signaling that the uptrend has broken. However, the S&P 500 and NASDAQ 100 have not yet caught this sentiment. And here it is important to pay increased attention to the dynamics of the first trading sessions of the new year. After a period of strong growth from February to October, gold went into correction. The November sell-off did not continue in December, and consolidation in the sideways trend was observed in gold. So far, the situation fits into a correction pattern in strong bull markets, with a low point at 76.4% of the original rally. In this case, it is the rally from the beginning of October 2023 to the end of October 2024, when the price rose more than 50%. The bullish pattern will be confirmed if the highs at $2,800 are updated and will make the $3,400 area the buyer's target. The cryptocurrency market is trying to get back on the growth path after the correction to the area of monthly lows. The crypto market has doubled its capitalization over the year, taking it to the 3.4 trillion level, having pulled back from the 3.2 area twice since 20th December. The recent pullback is being viewed as a strategic opportunity to buy during the dip, positioning for the next rally. The sentiment index in extreme greed territory also signaled buying confidence. The altcoin season has taken a breather, taking the index to 42, its lowest in 5 weeks. Bitcoin's steady reversal to growth over the Christmas holidays is reviving optimism. The price has climbed into the 100,000 area, pushing back confidently from the 50-day moving average. This may not be indicative, as it took place on reduced volumes due to the holidays. Nevertheless, it was enough to create an overall positive backdrop. Reduced liquidity in the coming days may well bring the price back to the area of historical highs near 107,000. The new week looks quiet in terms of major economic news, creating a calmer environment for the markets and giving economists more to think about than traders. On Tuesday, 31st December, it is worth paying attention to China's PMI estimates for December. The focus is on whether the world's second-largest economy will hold on to growth territory. The indices are close to 50, a level separating growth from contraction in both services and manufacturing. The results tend to affect the overall risk appetite in global markets, extending well beyond China. Thursday, 2nd January, sees the publication of the final PMI estimates for manufacturing in Europe. A strong divergence for German and Eurozone readings, with the preliminary data, could cause fluctuations in the Euro and European indices. Friday, 3rd January, sees the release of the ISM manufacturing PMI for the US. This is the precursor to the PMI indices. It has only been above 50 once in the last 2 years, indicating a contraction in manufacturing business activity. An acceleration of the decline is bearish for the dollar. However, it could also be good news for the stock market, increasing the chances of active monetary policy easing by the U.S. Federal Reserve. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.